Let's connect with Rahul Chadha. Joins us live from New York, and he's just stayed. What? How much? What is the time there?
So this is 10:40 p.m. So Nico, jolly for you. So from New York in the night.
10:40 is not late, bhai.
Sorry?
10:40 is not late.
Yeah, 10:40 is not late. Yeah.
It's okay. It's okay.
I was interviewing somebody for our Hong Kong office, and then again it was looking at the markets, and yeah. So
But thank you for staying up. Why are markets exhibiting so much of resilience? I mean, whatever has been thrown at the market, it just gets digested.
yeah, I think it is to do with the macro framework, and I think that is where a lot of credibility is given by investors to what the government's done over last 10 years. And first and foremost is the fiscal prudence, and we've discussed this number of times. Again, in a world which is saddled with huge debt, I see that in US. US is running the highest peacetime deficits. India is one of the few countries where again, debt to GDPs is still reasonable. You've got governments which is fiscally prudent, and I think that's taken well by the markets investors, which is why dips are being bought into.
And do you think this trend where dips would be bought into will continue?
So what is happening is in a bull market you see rotation, and I think this is what we saw in the bull market of 2003 to 2008. You had market moving between different sectors, and I think that's happening. So if you see prior to elections, it was this euphoria about the PSUs. That's sobered down a bit. We've seen tech do well as somewhere one gets the comfort that look again the end demand's bottom and seems to be improving with what the government's done for the rural semi-urban sector. Consumption seems to be looking up, and it was natural after going through a couple of years of pain. Inflation has come down. Basically, the consumer wallet or spends are going to get better. So that is a sector which is under-owned, underperformed. That should do well.
Okay, fair enough. Rahul, hi. Let's get in a sense from you as well as to what the expectation is this time around with respect to the Fed's preferred inflation gauge, how the markets are potentially going to react to that.
Okay, so I think that inflation's pretty much under check. So Fed was worried about inflation, but I think the tone changed about a month or two back, where what Fed is now focused on is the other side of the mandate, which is the full employment, or what Fed is now looking at is this 50 bips, 0.5% rise in unemployment. I think we've been talking about this internally for a while, that if you look at the job growth in US, that was very kind of a polarized, largely government sectors, largely healthcare and the hospitality sectors. But you didn't have any broad-based job growth in the economy, and that's what's coming under pressure. And I think now wage growth has also eased off, so it's highly likely that Fed cuts in September and may cut aggressively after that, obviously, because the real rates are still way too high for what the inflation in US is supposed to be, which is 2.5%.
Right, okay. Rahul, we won't keep you up too long, and I hope your day's done. Thanks as always for taking the time out.
Thank you.
If you like this video, then like, share and subscribe to ET Now.